Good morning and welcome to Fiscal Pulse Media. I'm David Cole. I spent 18 years as the CFO of a regional Medicaid health plan right here in Lane County, Oregon. Before I get into today's topic, I want to talk about something that's in the news right now because it connects directly to what we're going to discuss this morning. A few days ago, it came out in the news that the Oregon Health Plan is facing an $11 billion funding shortfall that covers the next three bienniums through 2031. $11 billion. That's just mind-blowing money. I can't even fathom how this is going to work now. So how that's spread out is that in the current biennium that we are in right now, that's a $490 million shortfall. Over the 2 years that will end in 2029, they're projecting an over $4 billion shortfall. And in the 2 years that end in 2031, they're projecting a greater than almost a $6.5 billion shortfall. Health plans are already exiting the Oregon Health Plan in the state of Oregon. Pacific Source, Providence, we talked about them last week. The state, they're scrambling. They don't know what they're going to do. And here's what nobody in the news coverage is saying. This didn't start last year. This started 30 years ago with a quiet decision about who was going to carry the financial risk for Oregon Medicaid. That decision and what it actually meant is what today's episode is about. In the early 1990s, Oregon launched the Oregon Health Plan. It was a pretty ambitious goal at the time. The goal was to bring more predictability to Medicaid, to cover more people with a defined set of benefits funded by a defined budget. The state needed a mechanism to make that work financially. They chose capitation. So your question should be, what does capitation actually mean? Capitation is a simple concept with enormous consequences. Instead of paying for every service after it happens, which is what fee-for-service is, the state would pay health plans a fixed amount per member per month in advance, regardless of what care those members actually used. That monthly payment is called a per member per month rate. Or also, you may hear it knocked down to just its initials, a PMPM rate, per member per month. The state writes a check, the plan takes the money, and from that point forward, the plan owns the risk for the member that's assigned to that money they were paid. I want to be precise about what full financial risk means because it gets talked about loosely. From the CFO's office, what does full financial risk mean? Full financial risk means that if your members use more care than the capitation rate assumed, you absorb that loss. The state doesn't come back with more money. There's nobody coming to save you. The federal government doesn't top you off. You modeled it. You priced it. You negotiated a rate with the state. You took the risks, so you own it. Here's how this plays out practically. Your actuaries project what it will cost to cover a Medicaid member for a month. They look at previous year's data. They do some actuarial voodoo. They look at hospitalizations, they look at primary care, they look at pharmacy, behavioral health, and they build assumptions, and then they run models, which then produces a number. The state, on the other hand, they have their own actuaries, and they do something very similar. They look at, on a statewide basis, how much did it cost to run the Oregon Health Plan the previous year. And then they try to make some adjustments based on what's going to happen in the new year. They had about 8 different risk categories where members were assigned how much they would get paid depending on which one of these risk categories they'd fall into. And then they figure out how many you're going to have in your area of each of those risk categories, and they come up with a PMPM that each county and then each health plan is going to get paid. So if those two numbers don't align, if the state's rate is below what it actually costs to cover the population, the plan takes the loss. Every month. I live this. Every month we were watching actual claims against our PMPM assumptions. When costs ran above projections, and they did, we couldn't just call the state. There was no more money. We had to adjust. So we would normally get with our physician community first, and we'd see, okay, are there some areas where we could tighten the belt here? We also would talk to the hospitals. Then we'd go to pharmacy, and there usually was some extra money in pharmacy. Pharmacy tended to be an area where things got funded pretty high. And that was usually an area where we could find some additional money to cover our potential losses. We tried to figure out where the variance was, and then we would use that money to plug where that variance was. That's what full financial risk actually looks like from the inside of a CFO's office. I called this a quiet shift because it didn't look dramatic from the outside. The Oregon Health Plan launched, plans enrolled members, care was delivered. Nobody held a press conference to announce that local health plans were now carrying population level insurance risk. But that's exactly what happened. Think about what changed. Before managed care, hospitals and physicians billed for services and got paid. Risk lived with the state and federal government. Under capitation, risk transferred to plans, to provider networks, to organizations like mine, LIPA. Physicians who had never thought about actuarial assumptions were suddenly operating inside a financial structure that depended on it. I laugh because I sat in many, many meetings where the physicians were, quite frankly, they were just dumbfounded by this whole process. Not because they were stupid, they were incredibly bright people. But this was just an area that they had no understanding of. So here's the part that matters for understanding what's happening today. When the risk transfer works, nobody notices. The plans keep going. The plans make some extra money, which they then pay out in bonus checks to the physician community, to the hospitals. And for many years, this was the case. Everything works. But when it doesn't, when costs outrun rates, when reserves erode, when a plan decides the math no longer works, that's when you get an exit announcement. We talked about this in the first two episodes. We first talked about Pacific Source pulling out at the end of 2025, essentially giving the state just a month or two of notice, saying, okay, we're done in Lane County. They had 90,000 members that had to find a new health plan, a new OHP health plan. And by the way, there was really only one other OHP health plan in the county, Lane County, and that was Trillium. And so 90,000 members had to enroll into Trillium and had to start working under their processes. And then last week we talked about Providence. Providence, they completely pulled out of health insurance. Ending December 31st, 2026, just at the end of this year, over 400,000 Oregonians are going to have to find new insurance. That's crazy. But those exits aren't surprises to anyone who understand the underlying risk architecture. They are the predictable outcomes of a model that was always contingent on the rate being adequate. So let's bring this back to the news. The $11 billion shortfall projected for the Oregon Health Plan through 2031. What does that actually mean in the language we've been speaking this morning? It means the state's funding assumptions are going to fall short of what it actually costs to cover the OHP population, potentially by a lot. Now here's the question every CFO of every remaining Oregon Medicaid plan is asking right now. Will the state's capitation rates reflect that gap between what they're going to have to pay and what they're getting paid from the state? Will the state fill in that gap? Or will the plans be expected to absorb it? Will the membership of OHP be cut because the state and the plans can no longer take on the risk? Will funding from different areas of the government budget be used to keep the OHP product viable? Because that's the mechanism. That's how the shortfall becomes a plan-level crisis. If rates don't keep pace with costs, the plans carry the difference. And at some point, like we're already seeing, they decide they're just not going to do it anymore. This is the architecture Oregon chose in the early 1990s. It wasn't a bad decision. It was a rational decision given what the state needed at the time. But it always contained this structural tension. The state controls the rates, and the plans carry the risk. If you're watching this and you work in healthcare finance, whether you're a CFO, a controller, an actuary, or an executive at a health plan, or financial analyst, which is how I started, you already know everything I'm describing to you this morning. You live it. But here's what I find remarkable. Almost none of this history is documented from the inside. I was in the room. I watched LIPA take on this risk. I built the models. I reviewed the reserves. I watched what happened when the rate wasn't enough and what happened when we managed well enough to make it work. I saw the excitement that physicians had when they realized they could practice medicine the way they thought it should be done and affect their payment schedule at the same time. I also saw their frustration when managed care eventually required them to document more, spend more time in administration than in actually seeing patients. They no longer were able to work as physicians. That frustration is still growing. That's what this series is about. Not policy from 30,000 feet, the financial mechanics from the CFO's chair. Next week we'll look at what happened as LIPA's financial sophistication grew and what it meant when a physician-led organization started understanding the risk transfer well enough to take it on directly. This article and the other 19 articles on Lane County OHP are on my Substack page. Please see the link in the first comment below. I'm David Cole. This is Fiscal Pulse Media, the heartbeat of smart business. Thanks for being here.